In this recording, we're looking at Summer 17, Question 4, focused particularly on company reconstructions, which will be covered in Strategic Finance Session 5 in the lectures. So the first thing you'll always do is look at the requirements. In the optional questions, use around 40 minutes to do it. First thing here is you want to compare the outcome of the two alternatives. This is the usual question you have in these company reconstructions. What's the final position of each creditor if there's a liquidation? Prepare a reformulated statement of financial position if the restructuring plan goes ahead, and comment for each alternative on the outcome for each creditor. So who is better, who is worse off from liquidation or a restructuring plan? Very similar to what happened in autumn 13 and summer 15 as well. So quite a predictable question in this regard. And then apart from the financial analysis, outline the other factors Ms. Fallon should consider whether deciding to go ahead with the restructuring plan, and then advise on which to proceed. So again, part A and B are linked together, and then part C is 3 risks you see facing East after restructuring. They don't say how to mitigate them, so it's just identify 3 risks, 1 mark each. Right, so again, it's a common enough question asked in 13, 15 and 17, so it's important to have a good idea how to deal with company reconstructions. So have a brief look through it. You're told here, now pause it and make sure you read through it yourself. Jane Fallon is Managing Director of East Ireland Hotels, and ask yourself, why am I told she owns a modest house and she has an equity portfolio of 800 grand? So everything is given for a reason. So here they own the East Coast Hotel, sustaining losses in 2013. Remember, it's now 2017, so 4 years of losses, or 3 years. Trade has improved the last 2 months, and she believes it will return to profitability. So again, it's only 2 months profitable, but she is confident it's going to return. They have a loan of 2.5 million at a variable interest rate, and it's secured by way of a fixed charge on the property. And we can see the property here, but the property now is below the loan amount. They failed to meet interest payments. They've making reduced payments, and also Miss Fallon has her own director's loan of 450k, and both of them are in non-current liabilities. So you need to be able to link the narrative to the financial statements. So that 2950 is made up of the secured loan of 2.5 and the director's loan, which is unsecured, at 450. So then you're given a forecasted statement of financial position, which you're going to use for the calculations. And you're also then told information here that there's 2 alternatives. They're either going to liquidate, or they're going to inject new capital and the bank will write off some of their loan. So again, that's the restructuring plan alternative 2. So we'll deal with that in a second. But the first instance is the liquidation. So your part A1 is who will get what in a liquidation. And they give you additional information, as they always will. What can you recover from each of the assets if it was liquidated? So your first step always is get all the assets in the statement of financial position. And what you're going to do is you're going to figure out what lump of cash is going to be left to allocate out in a particular rules, which are the liquidation rules. So we're going to start then A part 1, and we're going to say liquidation. So we're going to say, well, what are we going to get from the property? What are we going to get from other non-current assets? Then inventory, trade receivables, and cash. So liquidation is quite straightforward. It's you figure out the lump of cash you have, and then you allocate it out in particular rules. And we're just going to look at it in thousands. So the property here, you're told, property would expect to realize 100% of book value, so it's going to be worth 1850. And we'll put a little asterisk there. That is secured on a particular loan. So we'll come back to that again. Other non-current assets will get 35% of book value. So it's 298. That's their book value. 298 times 35%. So you're going to recover there 104. Inventory and trade receivables are 30 and 75% respectively. So 73 times 30% and 185 times 75%. Just taking those from the question. So again, it's just a nice and straightforward one to start off with, but just make sure you know how to approach it. And then cash is cash. That's just going to be worth 59. You always recover the full amount. So that means you have 2.1 million of liquid proceeds, i.e. hence the word liquidation, to allocate out. But if you notice here, you have a lot more than 2.1 million liabilities. So this company is in a net loss position. It has negative equity. So not everyone is going to get their money back in a liquidation. So that's why we need to have a certain set of rules, which we would have covered in Strategic Finance Session 5, called the waterfall. And the first one that gets paid always is the secured creditor, i.e. the bank. Now the important thing to watch here is the bank will only get the amount of the secured asset. So even though the loan is 2.5 million, we're told here, they've secured a fixed charge on the property. The property is now only worth 1,850. That's all they get. The residual secured loan, which is 25 minus 1,850, that is going to be 650. That becomes unsecured. So that is going to go down to the unsecured loans as well as the overdraft when we come to it. So that's a tricky one to watch for. So when the asset is lower than the loan, whatever's left of the loan becomes unsecured. If it was vice versa and the asset was worth more than the loan, the bank only ever gets the full loan amount. Whatever's left over of the proceeds goes to the next piece of the waterfall. So that means what's left after that then, 21 minus 1,850, you have 324,000 euro left to pay the rest of the creditors. The next person that gets paid is the liquidator. They're going to get paid 95, and that means you are then left with 229. Let's just leave 95 positive, I suppose, and we'll take it off, just to be consistent. So you're left with 229 then, and you go down to the next one. So it's all about having that waterfall. Remember, Camp 2 is an open book exam, so you should have that little waterfall cheat sheet ready going in. So next in this is what we call your preferential creditors. These are ones in terms of your employees and the taxman. And you're given both them here, wages due and tax due. So both of them go in. They're preferential creditors. They get paid before unsecured. So that will be 49 and 106. So taking off both of those, you're only left then with 74,000 euro. But look at all the people who are unsecured. That's the danger of having an unsecured loan, is that you're not going to get paid because you're further down that order of priority and you're going to get written off. So you have the bank, the loan, 650. So put a little star there, link that to the 2.5 million loan. So the 2.5 million loan, 1,850 was paid off, the other 650 becomes unsecured. The bank overdraft is 50, the trade payables were 245, and don't forget the director loan, which of course is belonging to Miss Fallon, because that would be a liability as well, that's 450. So your total unsecured creditors are 1,395, but you only have 74,000 to pay. So what we do is, under this rules, is everyone gets treated the same. So 74 divided by 1,395 means you have 5.3% of the amount owed. So that means everyone gets treated the same. So the bank, 650, they get 5.3%. The bank overdraft, it gets 5.3%. The trade payable, 5.3%. And the director loan, 5.3%. So you might often hear that said, everyone's getting 5.3 cents back for the euro. So that means you're only recovering 5%, you're writing off 95%. So it's a big loss, and that's where the 74 comes from. So in terms of the shareholder, they are wiped out because there's no money left. The 74 is paid, whatever's left of the 74 for unsecured creditors, and everyone else then is wiped out. So in that case, there's no preference shareholders here. They would be wiped out, as would the ordinary shareholder, which is M. Fallon, or Miss Fallon. So that's your first protocol, is you do your calculations, A part 1, calculate the final position of each creditor. So let's have a look then. It's always useful to do this out. Let's look at each creditor. Let's look at the bank, before, and let's look at after. Let's look at the taxman. Let's look at employees. Let's look at, what else am I looking at? Trade payables. And then we'll also look at the M. Fallon or Miss Fallon. Right, so that's an important one. So we have to look at each one. Before the deal happened, this is always a useful table to do because it allows you to compare them directly to the restructuring plan in a second. Before the deal, the bank was owed 2.5 million plus 50. So the normal loan plus the overdraft. After, what did they get? Well, afterwards, they got 1850 from the property, and they got 34 from the bank loan and 3 from the overdraft. So they received 1887. So that means written off was the difference. So they wrote off the difference 663, or in percentage terms, they're writing off a significant chunk, 26%. So again, they're not going to be happy that they're writing off over a quarter of that loan by putting this company into liquidation. So look at the before and after. So before, the taxman was owed 106, and after it gets 106 because it's a preferential creditor, but no future tax stream. Company now liquidated. So again, although they're getting their money back, the taxman, they're not going to have any future income because the company is now in liquidation. So that means it's not an ideal situation. Same with employees. Employees owed 49,000, get them, but now unemployed. So they lose their job. So again, it's not a great one for those. Some of them may secure future employment with the operator, but some of them may not. So it's not an ideal one. Trade payables, 245, and afterwards it's now 13. Right, so they make a big loss. Right, they have written off your 95%, which is 232, and may lose future business. If this business goes bust, they may not have East Hotel as a supplier again. So that means they're worse off. And Miss Fallon, think about it. So Miss Fallon now, before, she owned the company plus a 450k loan. Afterwards, she has no company and she only has 24,000 of a loan. So she is completely wiped out. So she loses a huge amount. She will recover no value from the shareholding and just get 24,000 from her loan. So for most cases here in the liquidation, the bank won't be happy because it loses 26%. Taxmen and employees get their money back, but they have no future income stream. Trade payables won't be happy, and Miss Fallon won't be happy. So that's usually why in most instances there tries to be some type of restructuring plan to make it better for each creditor. Make sure you have that table done and you understand where it's coming from. So now we're looking at a reformulated statement of financial position following the restructuring plan, and then comment for each alternative outcome. Who's better, who's worse? So this is where students often struggle, is what is the restructuring plan looking like? Well, Miss Fallon is going to inject 500,000 equity. So that will be debit bank, credit ordinary share capital. The bank is going to write off 400 grand of the loan. So going from 2.5 million to 2.1. So that's the write-off for liability. That is debit the loan, reduce the liability, credit retained earnings. This is the gain. Will continue to be secured in the charge, and Miss Fallon will have to give a personal guarantee of 300,000. And she has to maintain that 300,000 in her bank account for the duration. And her loan will be written off. That's another reduction in liability. So if we go down through A part 2, very similar to what was asked in 2013, your statement of financial position. So you have the property, that doesn't change, 1850. And you have other non-current assets, they also don't change. So nothing changes unless the plan, because it's not a liquidation now, so you're not selling it off, that's 298. So the recovery amounts don't really matter, it's whatever was in the book. You have inventory, trade receivables, and cash. So inventory stays the same, 73, as does trade receivables. Just be careful here now. There's going to be 559 here, which is plus 500. Because remember, if Miss Fallon puts in 500 of equity injection, well, that means it goes straight to cash. Total assets. So that is total assets 817 plus 2148. So 2965 is your updated total asset side. Nothing changes other than the bank, which gets in the proceeds. So there's quite a good buffer here now for taking the business forward. The ordinary share capital, the retained earnings, and then you have current liabilities, trade payables, wages, the bank overdraft and tax, and then you have the non-current liabilities, which is the loan. So ordinary share capital, that goes up by 500, so it goes to 600. So remember the debit and credit, if you want to think about it, it is debit bank 500, credit ordinary share capital. Now again, you might say there's share premium in there. We're not too concerned about that in SFMA. Retained earnings is a tricky one. It's going to be the negative 1035, which is a net loss to start with, plus 400, the written off bank loan, reducing a liability, plus 450, the written off director's loan. So that's going to be minus 185, and your equity is 415. So that's the tricky one. Just think about your debits and credits. If I'm writing off two loans, that's debit the loans, and it is credit retained earnings. It's a gain because you're writing off a liability. Right? Trade payables doesn't change. None of the current liabilities change. So they stay to 450. They're your current liabilities because you're not doing a liquidation, so they all maintain. And the loan, be careful now, that started at 2950. The bank wrote off 400 and Miss Fallon wrote off 450. So 2950 minus 850. So your remaining liabilities now are 2.1 million. So still a significant amount of debt in comparison to the equity. So 21 plus 450 plus 415. 2965. That is total equity and liabilities. So again, you have to make sure you're comfortable. What are the debits and credits? Injection of cash is debit bank, credit ordinary share capital. Writing off of loans is debit the loans, credit your retained earnings, because that's a gain that you're making. So that is the second position. Now the company has a decent amount of liquidity, but it still has a significant amount of debt. So what they ask you, that's the first one, prepare, formulate a statement of financial position, but then comment on each alternative. So what we're doing again is we're doing this table out, before and after, and we'll see who's better off, who is worse off. So the bank before were owed 255. Afterwards, we'll go paid, left, and written off, just to do it separately. And we'll call that written off. So afterwards, the bank were owed 255 before. They were paid none. Because remember, they weren't actually paid anything here. The loan is still outstanding. So the left outstanding, 2.1 million, plus the overdraft of 50. And they wrote off 400. The asset is still secured, or the loan is still secured on the asset, as you were told. But now you get a PG, so the extra note here, if you want to put in, PG of 300k. So it's less risky than before now because you have a personal guarantee as well in cash form. So the bank is probably a small bit better off, but there's still a lot of debt there. And they haven't taken any money off the table. They haven't been actually paid anything. Taxman has still 106, so still left at 106, they've written nothing off. And they have future income stream. Because this business is still going to be there. Same with the employees. Hold their jobs, so they'll be happy enough. Trade payables, 245. So they're going to recover a lot more than they would have in the liquidation scenario. But what we have to be careful now about is Miss Fallon. So Miss Fallon, she owned the company, had 450. Afterwards, the written off, the 450 loan is gone. The 450 is written off. She now has to give a PG of 300k, and she has to put 500k in. She has to put 500,000k into East. So a good student will notice there, that's 800k. So what she has to do is liquidate her equity portfolio, which you're told was 800k. That means she's concentrating all her assets now. Everything she has is tied up in Eastern. So if it doesn't go well, she's going to be wiped out. So it may or may not be a good decision, and we'll talk about that then in part B in a second. So overall then, in terms of a liquidation, the bank would get 1887. Here it's going to get more, and it also has a personal guarantee. So the bank is probably better off than before. The taxman and the employees are better off because they're always going to get their money back, but they also have the future potential now from the company still operating. And the trade payable is a big winner because before the trade payable was only getting 13, writing off 232, so it's going to get that in as well. The one that's probably worse off here now is Miss Fallon has to put up 800,000, 500 into the company, and 300 as a personal guarantee, and it's going to wipe out its loan. Now you will see in the solution, just to make sense of it, they would have said, let's come down to the solution here. They would have said, before in liquidation they're getting 24, in the restructuring they're losing 109. Now where that 109 comes from, just to make sense of it, it's the value of the equity in the restructured company. So after the restructuring, the company is worth 415. So that's what her shareholding is worth, plus 415. But to get that, she put in 500. So actually, she put in 500. It's only worth 415. She lost 85. And not only that, she lost 24 because she's not getting the 24 from the liquidation. So that's where the 109 comes from. Again, it's not the major point. You don't have to show it really, but just to show each of them, you should be able to get the rest of those in that restructuring column. So essentially, Miss Fallon would have been plus 24. She's now negative 109. But the only benefit is she has a viable company going forward. It has 559,000 in its current assets now in terms of cash. So it does have enough buffer there to go forward, but it still has a significant amount of debt. So there are the types of comments we would expect in terms of that A part 3. The main winners there seem to be all the other creditors. Miss Fallon doesn't really seem to be coming off too well, particularly when you take in the personal guarantee as well. So that's where your comments are going to come from part B. Apart from the financial analysis, what are the factors Miss Fallon should consider? And don't forget then, second sentence, based on these factors and A, should she proceed with the alternative or not? Well, the first thing we're obviously going to say here in terms of part B is 1, concentration of Miss Fallon's assets. So what we mean by that, now you can tease it out a bit more. She's putting 800k more now into the company. So that means she has all her eggs in one basket. So if this company goes bust, she'll lose the 500k that was put in there because that'll go to the bank, and the other 300k, the personal guarantee, that's going to have to be put in as well. So she has no future assets left to capitalize East in future. So if it does go bust in the future, she's going to be wiped out. The only thing she's going to be left with is, as you're told in the question, her modest home. There is no guarantee the company will turn around. 3 years of losses, and she's only mentioned 2 months of upturn. So you're only told in the question there's been 2 months of an upturn. So that's not that much long, last 2 months. She believes the business will turn for profitability, but maybe again there's a bit of sentimentality there that she doesn't want to lose the business, even though it may not be commercially viable. So she has to be careful. Is she guaranteed to turn this company around? Because if not, she may be throwing good money after bad. So on the balanced probabilities here, the advice would be do not go ahead with it. Or at least look for a better deal with the bank. So sometimes they'll ask you an exam question, what better deal might you look for? Well, it could be, for example, you might look to say, I'm not giving the personal guarantee of 300k. and that gives her a nice buffer of herself to have personal assets, so she's not fully concentrated in just all her assets being in East. Or you could ask the bank for a write-down of more than 400. So compare their position before and after the liquidation and use that as a negotiating power. And so there are different areas of where you can look to improve it, but reality as it stands now, it's not a good position for Miss Fallon. She's putting too much of her assets in and it's too risky because there's no guarantee the company will be success post-restructuring. Particularly when you think of a good student will bring in the likes of Airbnb and how competitive this particular environment is now. So your last requirement then, so part A and B are very much linked to the calculations. It was a more general run around risk management. What are 3 risks facing East if they do restructure? Right. Well, one of the first ones for part C, right, would be significant debt. And again, use your measure if you want to. You have 2.1 million of debt. You have only 415k of equity. So you could do a little gearing ratio if you wanted there. So I'm just giving you the high level points, but it's going to be significantly geared post restructuring. You still have 2.1 million of debt. You're barely profitable, so you may not be able to pay it. Right, so that's a big concern still, because there was 3 million debt, there's only 800 written off. So there's a question mark there around the financial structure, the capital structure post. Second thing then, of course, is the business risk. Talking about 2 months of an upturn, that may not be enough, and you might link in there the likes of Airbnb, etc., becoming more competitive. So it's becoming a much more competitive industry, and maybe you're not going to be able to sustain a business. The last 3 years, remember, you're not really in the depths of recession now, so maybe that's an indication that the company is going to struggle in terms of the long term. So that's 2 of the key risks. You're only asked to identify the risk, so expect 1 or 2 lines is sufficient. You're not asked how to manage it or how to mitigate it. So for East post-restructuring, now remember, you're asked for risks for the business, not risks for Miss Fallon individually. Right? Another risk, of course, is the value of the property. Because if the value of the property goes up or down, that may mean the personal guarantee is brought in. So the value of the property, that will drive whether East can repay loan if it gets into trouble, or whether the PG is called in. So that's an important one as well, is, right, as the value of the assets go up or down, that will mean if the company gets into difficulty again, it may not have enough money to actually pay the loan, which means Miss Fallon's personal guarantee will be called in. So that's a big trouble as well. So there are 3 big risks there. Now you might have come across other ones as you're looking down through it, in terms of management risk, the ability to turn around the business, as we've mentioned as well. So there are different ones you can bring up, but they will be the 3 main ones for 3 marks in terms of the risk that East would face post-restructuring. Right. So that was a good question. Summer 17, question 4, is focused particularly on the area of company reconstructions, which is all covered in Strategic Finance Session 5. So have a look at Summer 15 paper and the Autumn 13 paper as well, all of which cover similar questions.